I'm going to, okay, I'll just hit, okay. I'll get rolling then. The title of my, thanks for having me tonight. The title of my talk is Planning for Growth and Succession in Healthcare Practices. I'm a physician practice consultant with CLA, and this question has come up in the work that I've been doing with practices here in North Carolina and across the country. Many groups I work with are facing the impending retirement of a founder and the question of how to recruit and pay the next generation of physicians. Actually, I gave this talk at the MGMA Leaders Conference in October 2024. Yeah, I'm going to see if I can try to go to slideshow. Okay, I'll go to slideshow there. Got it. Is that better? Okay, so here we go. Okay, so here's the objectives. Inspect end of career obligations and their impact on practice sustainability, distinguish opportunities to prioritize a long-term growth and succession over individual interests, prepare negotiations that are fair and equitable while supporting the practice's growth and attractiveness to new physicians. I do have questions at the end, but since we're such a small group, you can interrupt me if you like. Let's get into my background. I've been working with physician practices since 1991, or for over 30 years. I started my career in the tax department of a St. Louis accounting firm where I'm from. We then moved to Minneapolis, and I joined a small CPA firm that only served medical practices. In addition to accounting, we did management consulting for our clients. The firm's owner was an author and industry leader in accounting for medical practices. I was then recruited into an accounting role for a health system, which happened to be a client. The health system began buying practices, and I moved into a business development role in which I prepared valuations and operational analysis for clinic acquisitions. As the health system's clinic network grew to approximately 60 clinics, I was responsible for prioritizing capital and spending for the clinic network. I built financial models for new sites and additional service lines, such as adding optical departments or adding diagnostics and imaging to primary care clinics. I then was recruited by a CPA firm and spent the next 13 years working with medical practices across all specialties. I was recruited and spent 10 years as a CFO of a 40-doctor neurology practice and 2 years as the CFO of a 20-doctor ophthalmology group that owned Surgery Center. At the neurology practice, I was a compliance officer, and patient scheduling and revenue cycle departments reported up to me. In addition, during my time as a clinic CFO, I served as president of the Minnesota MGMA state chapter. Currently, I am the vice president of the North Carolina MGMA Charlotte Metrolina chapter. So while I'm now serving as a consultant, I do know what it's like to work inside a physician practice. Let's get into the objectives. Inspect end of career obligations or impact on practice sustainability. End of career obligations. We typically see 4 different types of agreements at the end of a physician's career, and I'll talk about each one of them. Most groups have stock and deferred compensation agreements. Not every group has a part-time physician employment agreement, so I will spend less time there. Severance agreements exist in some practices, so we'll spend a few minutes there as well. We're going to talk about deferred compensation. Okay. You've probably all heard the term deferred compensation, but you might not be aware of all its components. Deferred compensation is typically based on the gross charges or work that has been performed that has not yet been collected by the practice. Deferred compensation represents the collectible portion of the accounts receivable. It is typically calculated using the year-to-date collection percentage times their accounts receivable balance that is weighted by the age of the account. Current balances are more likely to be collected than those over 100 days old, so they are given a higher weight. The amount calculated is usually paid to the departing physician over a 3 or 5 year period. Given the age range of the physician population, in which half of all doctors are over 55, it is crucial to have a limit on the amount that can be paid as deferred compensation at any one time. This limit is usually expressed as a percentage of the physician compensation pool of the prior year. I typically see the limit expressed as 2 to 4% of the prior year's total physician compensation as a safeguard or limit in place. This doesn't mean the retiring doctor doesn't receive the money due to them. It just means the payments will be spread out over a longer period of time. Keep in mind, there's only one pool of money, and the amount paid to the retired doctors as deferred compensation reduces the current year compensation available to the other doctors. Also, for those of us in the room that are accountants at heart, deferred compensation is deducted by the practice as compensation and is taxed as ordinary income by the recipient. Here's a little bit of math. I prepared an example of the calculation of a practice with deferred compensation limit set at 3% of the prior year's physician compensation pool. You know what, could you see the slides better if I hit the panel, or can you see the slides?
We can see the slides really well.
Okay, got it. That's just, okay. In this example, for the previous year, the revenue was 20 million and the practice expenses or overhead was 12 million. Doing the math, the amount available for physician compensation that year was $8 million. 3% of 8 million is $240,000. So the amount paid to all doctors eligible to receive deferred compensation was limited to $240,000 that year. If there are three physicians, each set to receive $100,000 in deferred compensation that year, they would receive a reduced amount. Instead of receiving $100,000 each, they would each receive $80,000, and the excess $20,000 would be carried over and received in a subsequent year. A couple of notes about accounts receivable. A practice should review the accounts receivable balance to make sure more dollars are not being paid out in deferred compensation than are being collected by the practice. The following should be considered in respect to the accounts receivable. What is the policy on sending accounts to collection, and is account policy being followed? Most practices have a policy, but revenue cycle staff, if you can find them, get busy and tied up, and the policy often isn't being followed. The question should be asked, are accounts sent to collections when the staff has time or when they can get around to it? You don't want to pay a departed doctor based on account balances that won't be collected. I also think the calculation should include a weighting that assigns less value as the balance ages. It is harder to collect the money and is less likely the practice will be paid as the account ages. And I can tell you from personal experience in working in large practices and small practices, there's only a certain number of revenue cycle staff, and that's one thing that gets forgotten, to send accounts to collection. So keep that in mind. As an example, I worked with a 6-physician specialty group in the Midwest that treated all account balances less than 270 days equally. I suggested that the older balances were worth less than those balances that were current or 30 days old. Some of the group's members decided that they liked getting paid for accounts that had aged and did not want to change their calculation. So in my opinion, these departing individuals were going to be paid more. We're going to be paid more than what the practice was going to collect on those accounts. I don't believe these individuals looked at the actual economics of the practice. They simply looked at what would be best for them. It felt like these individuals fell into the trap of the senior shareholders before me received this benefit, so I am entitled to it as well. I've seen this happen in other professional service firms, such as accounting practices, law firms, and also in medical practices. Dive into stock purchase agreements a little bit. Stock purchase agreements vary from practice to practice, but they have some common themes. The calculation might be a simple stated value for the stock purchase, or it might be a complicated Excel spreadsheet exercise. Stated value means just as the name implies. As an example, it might be $1,000 for shareholder buy-in and the same amount on the buyout. The value paid to the physicians is in compensation and not on the stock purchase or sale. For the economics of the practice, one additional doctor in the practice means an existing physician's overhead allocation is reduced on the compensation formula, not that they will receive a large benefit from the stock purchase of a new doctor buying in. What this means is that rent and other fixed costs are spread more ways. It really goes to the philosophy of the group. I have seen the stated value used more frequently in practices that have more than 20 shareholders compared to calculations used in smaller practices. On the other hand, some practices have a formulaic calculation based on the balance sheet or equity of the practice. Equity refers to the amount that the assets are greater than the liabilities. One thing to keep in mind is, are the items on the balance sheet truly corporate assets? Some groups have automobiles on their books. These cars in reality might be more personal than corporate in nature. In addition, some agreements require complex calculations of items, such as recalculating the accumulated depreciation or the amount of depreciation that has been taken in prior years. I've also seen calculations that require a portion, typically 50% of the accumulated depreciation balance, to be added back to the stock value. This is just one more reason to work with your accountant to keep the depreciation schedule updated for items that are no longer being used by the practice. It sounds simple, but try to review and clean up assets listed on the depreciation schedule at least annually. Many practices turn over or replace technology such as laptops, desktops, or printers every few years. It is easy to add new items and to forget to remove the abandoned or replaced equipment. We also see this when a practice has a new site or location. The equipment or furniture of the old location is still on the company's books. It wouldn't be a big deal, except the departing individual is paid on and the new shareholder buys into items that no longer exist and have been abandoned or replaced. A specialty group in the Midwest, unfortunately, had not been reviewing the depreciation schedules on a regular basis and had a 50% add back of the accumulated depreciation as part of the stock buyout calculation. They had 10-year-old laptops on their books and wrote a check to a departing shareholder for his portion of the clinic assets that no longer existed and had been disposed of previously. The new doctor buying in considered me a hero when I pointed this out and recommended that those assets that they were no longer using be removed from their depreciation schedules. So it was not an ideal situation for the practice because they had paid the departing shareholder for these items that they no longer owned or didn't exist, but the issue was corrected, and so the new shareholder paid a lesser amount than was paid to the physician buying out. Stock agreements should be located and reviewed to make sure they've been updated and that they are current. Corporate structure might have changed or a merger has taken place. The agreements of one practice I worked with were so outdated that they required a notice of a shareholder meeting to be sent 7 days in advance by regular mail or by telegram. That was quite a chuckle in the board meeting when we talked about those requirements. I've also seen cases where special allowance have been made and the agreement was not followed. One practice paid more than it should have in stock payments to a departed individual because the liabilities were not subtracted to calculate the equity balance. The practice had taken out a loan for the first time, and that balance had not been subtracted in the book value calculation. Be aware that there also might be significant liabilities that have not yet been recorded on the financial statements. These might include unpaid drug bills, IT or practice management system invoices that the practice has already received the benefit for, but the payment has not yet been made. It is not uncommon as part of year-end planning for practice to decide which invoices will be paid and which invoices will be held and paid the following year. In which there is an ownership transition, it is especially important to have a clean cutoff at year end. There is a significant difference between stock and deferred compensation. And the most significant difference is that deferred compensation payments are an expense on the financial statement. While stock payments reduce the cash that is available for other purposes, there's no expense or deduction for these payments. The recipient will also receive more favorable capital gains tax treatment on the stock payments. I won't get into the details of the tax planning aspect, but there is a significant difference. To say it another way, the new physician stock purchase should be made with a personal check worth after-tax dollars. I've seen medical practices that wanted to treat the new physician stock purchase as a subtraction on the compensation formula, just like a health insurance or continuing education, and it doesn't belong in those pre-tax items. The stock payout is after tax for the physicians, so the stock buy-in should be an after-tax event as well. I can't emphasize that's really important. So that's it for stock and deferred compensation. I'm going to talk about part-time physician agreements. Part-time agreements have become more common as the physician population ages. The economics of the practice can get challenging if there are multiple physicians that elect part-time status. There is typically a separate compensation formula for the part-time physicians, which feature a reduced overhead allocation. Unfortunately, overhead items such as rent do not decline if an individual desires to work part-time, and it usually means the remaining full-time physicians are allocated more expense as part of the compensation calculation. Therefore, an arrangement works well for one doctor might not scale well when multiple doctors are allocated reduced rent and other costs. Limits should be put in place so that the number of part-time doctors doesn't outweigh the individuals working full-time. The last thing a practice wants is for the full-time doctor's compensation to be reduced because of the desire of some physicians to work less. As an example, I've seen a practice that had several physicians join at about the same time. As the physicians grew older, they wanted to elect part-time status at similar times. The economics of the practice did not support multiple part-time positions. Eventually, the full-time physicians' salaries did decline because of all the increased overhead allocated to them due to the larger number of part-time physicians. Unfortunately, this practice did see some of the full-time physicians leave because they thought their salaries were no longer market competitive. I'm actually watching this right now where 3 physicians left a group and they went to join another group, similar specialty. And the call schedule is another significant consideration. The size and specialty of the group typically determines if a part-time physician will be allowed out of call. The call burden of a 5-physician OBGYN practice course is much different from that of a 30-doctor specialty group that doesn't have hospital coverage. Many groups allow a doctor to work part-time, but still must share call responsibility. Some groups have a calculation that allows a senior or part-time physician to buy out of the call responsibility. This, of course, varies greatly by the specialty and group size. Due to the demographics of the physician population, it is wise to place limits on the number of years an individual is allowed to work part-time and the limit on the number of part-time physicians allowed at any one time. I've also seen the limit expressed as a percentage of the full-time physician FTE count. If a part-time physician is assessed less overhead in the part-time compensation model, they also should be using less resources If done properly, the rest of the physicians would have access to the exam rooms and staff of the physicians that are no longer working full-time. Just spend a moment on severance agreements. I don't see that too often. Like I said, I've seen severance agreements a few times in working with small practices. Is typically a flat dollar amount paid as additional compensation to a departing doctor. It is an easy source of hard feelings and discontent, since this payment, of course, reduces the other physician's compensation. Aware of one occasion in which a specialty group lost physicians because of the hard feelings created by the severance payments to a departing doctor. That reduced, of course, compensation. And so in that situation, these physicians were unhappy that their compensation was reduced, and they would not be receiving the same benefit as the senior doctors. And as an example, I went to a conference, and the administrator of a 3-doctor specialty group in the Midwest shared with me that they weren't able to recruit new doctors. And she asked me if I had any suggestions, and I quickly learned they had severance agreements in place for the senior doctor, and they had hired an associate or two over the years, but no one was willing or wanted to the partnership track. And so they quickly left after they understood the situation. I guess the severance agreements had been not been shared to them during the recruitment process. We're going to pivot a little bit into next objective: distinguish opportunities to prioritize long-term growth and success over individual interests. Long-term growth. Some individuals wear blinders and only look at and consider their column on the income distribution spreadsheet. A financial projection should be developed to project what growth actually means to the practice. Additional revenue to be received and overhead costs that can be spread to additional doctors by growing the practice should be forecasted. Having more doctors might allow for additional revenue streams, or having a service the practice currently refers out. Having more doctors also most likely means there will be more variability in the physician's production level. Some subspecialists, due to the nature of the patients and the illnesses they treat, typically will have longer visits and see fewer patients per day, and might have lower production than the other doctors. A change to the compensation formula involving a larger equal share might be considered. 100% production or eat what you treat compensation model might not be ideal for that group as it grows larger. The last objective: prepare negotiations that are fair and equitable while supporting the practice's growth and attractiveness to new physicians. Recruitment and negotiations. Practices need to take a new approach from what they have always done because of the shortage of physician candidates. Many candidates of course, are choosing industry and health systems over independent practices. What has been done before to attract candidates probably will not work today. Take a hard look at the practice's compensation agreement from the perspective of a new doctor. Is there an equal share, or is the calculation 100% eat what you treat? Can a pathway to success be easily explained to a candidate? Here's a success story. I work with a specialty group that's compensation formula required new shareholders to have a 4-year phase-in of the profits from their ancillary departments, such as MRI and infusion. Like a lot of groups, they experienced physician retirements and they were unable to recruit replacement doctors. This forward-thinking group removed the 4-year phase-in of ancillary net income, and subsequently, this group has been able to attract new physicians. This change allowed them to add physicians and remain independent. Otherwise, they might have had to merge or sell because they had leases and future rent commitments without having enough doctors to fill the exam rooms and to produce revenue. We got a couple of closing thoughts. Look at the practice's buy-in from a new physician's perspective. Is it reasonable for the specialty and the market? Can a candidate see the path to ownership? Is there a benefit to becoming a shareholder? Does it mirror the other physicians' agreements? This is a few questions I've learned quickly. People don't like to raise their hands, but I just this will give you a couple things to think about. Have the agreements been reviewed in the past 10 years? Can the buy-in and buyout be easily explained? Are the agreements the same for all the doctors? And this is a big one. Has anyone been through a buyout which created hard feelings or litigation? I have worked in a practice where there was hard feelings and litigation. A valued partner decided to leave the practice, and the definitions were not clear. The agreements were not clear, created a lot of hard feelings and mistrust. So here's a call to action. A change from what always has been done is needed. It is very important to understand the cost structure of the practice and how many doctors are required to support the overhead. So crack open the documents. The founder's agreement might be different from others. Model the language and see if it still applies. Determine how many doctors are needed to support the current cost structure. Model and project the deferred compensation, and need to change what the practice has always done. I have time for questions, but after doing this a few times, I'll lead off with a couple that have come up a few times. So first question, when should you get the attorney involved? And my preference is to make sure the key physician leaders are on board with making a change and a few of the deal points as well before getting the attorney too deeply involved. Second question that comes up a lot, what to look for in the agreements. These are obviously the agreements are sometimes they're an inch thick, multi-pages, but make sure the definitions are clear. This was a significant issue in the litigation with one practice I work with. The definition of full-time was a slippery slope. Is it defined by days worked, days in clinic, or production? Many clinics have a high producer that sees more patients in four longer days than others do in 5. Would that physician be considered full-time? And this also comes up. What's the process and timing for making a change to the agreements? The only thing I can say is plan on many physician meetings, lots of time, lots of discussion with your partners, and plan for more legal and accounting fees. If you're contemplating a project such as this, be sure to budget for it when you're thinking about it, because it will be much different than the legal and accounting fees you paid in the prior year or what you typically pay. Well, that's my presentation. Do you have any questions?
So, Mark, I saw you give this presentation in Denver at MGMA. So,
really?
Yes.
Okay, I can't tell. Is that who's speaking?
This is Noah. I'm sorry.
Okay, got it.
Yeah. So, yeah, I saw you give this presentation in Denver. One of the questions I had is, as far as agreements go, what is your thought on having an overhead floor?
Say that. I think I know what you're talking about. An overhead floor to be a shareholder?
Correct. Like especially with shareholders that start winding down. So that there's a minimum, to me, there's always a minimum fixed cost, even though your variable cost will vary, but there's still a fixed cost to keep the lights on that needs to be shared. And some shareholders sort of get upset when they're not, when other people are not paying sort of their share just because it's driven specifically on revenue.
Sure, and that really depends. When you've seen one compensation formula, you've seen one compensation formula. I'll say a couple things, and actually that's a lot of the work that I do here in Charlotte and frankly in around the country is on compensation and what is fair. Working with a group right now where we did if we took a look at what the average we took a look at, they had higher and lower producers. We took a look if a physician fell below 70% of the average, that physician went to an alternative compensation model. So there is, I do believe there should, when they're, can I ask how large is the group, Noah, you're talking about?
55 providers.
Oh, then that's, yeah, there still should be I agree with you, compensation calculations work better when there's a floor or excuse me, a production floor to be allowed in the group. Otherwise, the calculation really doesn't work well. I'm working with a group right now that has that just instituted a separate compensation model for physicians lower than they have about. This situation was in the Midwest. They have about 25 physicians, and they merged. One group was their average production was higher than the other. There were two doctors that were, after the merger, were their production was 70% below the average, and so we couldn't. The compensation formula didn't work for them, but we're instituting a second compensation formula, but their overhead is based on the practice's average, so they're still being charged overhead at the they're still being charged overhead. So that's a common issue that most groups face, and I'd be happy to have a side conversation with you about that.
No, I understand. I just, and I will say that has stopped actually practice acquisitions because if you got a 10 doc practice, you're looking at acquiring, and their average revenue is 2/3 of what your average revenue is for your shareholders. It does put the brakes on quite a bit of things like that, because you get that division of overhead gets very complex, and it scares people.
Right, and I can share with you at the neurology practice, I had an individual, typically you were a new physician. It was 2 years to shareholder, but if the physician was not at 75% of the average production, that physician, in spite of every other measures, he or she was asked to wait another year to get their production, because it just didn't work. They weren't successful on the formula. That was one. And then I've also seen on the other end, there's typically, as you mentioned, a percentage of production or percentage of their average. Then physicians can still work in the practice, but they have an alternative formula.
I appreciate that. Thank you.
Any other questions? Well, we thank you guys for your time tonight. Please take note of Mark's email and phone number. If you'd like to ask him questions directly, feel free to email him.
Thank you.
And if you,
yeah, go ahead.
Thank you.
You're well. Thank you for attending. And Charlotte, if you like, I can send you the slides in case you would like them.
Oh, that would be great. Thank you.
Okay.
Thank you, Mark.
Thank you. Have a good night. Or yeah, thank you. Have a good night. And I'm available. Excuse me, if you have any questions, please feel free to reach out in email or call. Thank you.
Thank you for your time, Mark. We appreciate it.
Bye-bye.
Bye-bye.
Stop sharing.